You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.
You know, the global economy is going through an interesting time, and we're going to talk about it on today's podcast. Welcome to India Insights, brought to you by PGIM India Mutual Fund. Everybody, Ahalya here, keeping you company. Of course, we're going to hand over the mics to Ankit Jain, as per usual. And joining us on our podcast today is Puneet, a veteran of India Insights by now. Now, like I said, you know, the global economy is going through an interesting time, and that's because economies all over the world are kind of playing by their own rule book. Each economy is kind of facing unique problems, unique dilemmas, and the solutions are therefore also quite unique to those geographies, right? And India, likewise, has maintained certain stances that we're going to uncover specifically about the interest rate. That's what our conversation is going to be about, how India's interest rate and the general trajectory and trend has been impacted by global macroeconomic phenomena, whether it's been impacted by that, and how we're really predicting the trajectory to go and also further impact investments both within the country and generally, you know, on the global level as well. So handing it over to Ankit, now let's get started with PGIM India Insights.
Thanks, Alia. India has seen a stable interest rate regime where our 10-year bond yields have hovered around 6 to 8% for almost half a decade. And inflation also has been under control. I am Ankit Jain, and you are listening to PGIM India Insights. And today I have with me Puneet, Head Fixed Income, who will take us through his views on interest rates in India. Hi Puneet, it's good to have you back.
Thanks, Ankit.
Puneet, if you have observed last 18 months, though inflation has started coming off, but RBI has kept the repo rate still at 6.5%. So what's your outlook on interest rates in India?
Yeah, you're right, Ankit. And first of all, thanks for having me again on the podcast. So on the outlook on interest rates, what I'll say is that we don't expect RBI to cut rates over the next 3 to 4 months. So basically, we expect RBI to be on pause till the end of calendar year 2024. Given the current growth inflation dynamics and RBI's concern on growth in unsecured lending and certain other segments of the banking credit, which they have been voicing concerns on. We think that RBI will be on pause till the end of the year, and we expect rate cuts to start only from calendar year 2025 onwards. Of course, there are enough reasons why RBI should be cutting rates, and predominantly we think high real rates, high real yields, normal monsoons, which are progressing quite well, and the start of the global monetary easing cycle. These things provide the backdrop for RBI to start cutting rates from next year onwards.
Sure. So with falling inflation also, eventually what you're trying to say is in the calendar year 2025, RBI will start cutting rates. In the last 12 months, from the highs of 720, 730 on the 10-year bond yields, today we are already at 6.85. Where do you think is going to be the next stop?
Yeah, I mean, we have seen a decent rally in the Indian bonds. We generally think that the yields will continue to trend lower gradually over a period of time. If we look at the current macroeconomic conditions, then I think India is in a sweet spot. Indian bonds are in a sweet spot. We have very stable and strong macroeconomic fundamentals, whether it's the current account or the inflation numbers, especially core inflation. We look at the favorable demand supply dynamics in the bond markets, especially the FPI inflows, which have come in both before and after the inclusion in the JP Morgan bond index. Obviously, we have spoken about the possibility of rate cuts from next year onwards. And then we also think that there is a fair probability of India's sovereign rating getting upgraded over the next couple of years by the international rating agencies. So all these factors give us the confidence that yields will continue to drift lower on a gradual basis, and we expect the benchmark 10-year yield to go towards 6.5 by Q3 or Q4 of FY25, because generally we have seen that yields react much in advance of the actual rate cuts, and we expect the 10-year bond yield to align towards the repo rate over the next 6 to 8 months.
Sure. In fact, the JP Morgan bond inclusion, which you were mentioning in your last interaction with us, has already come through. Hopefully, before we interact again, India's sovereign rating upgrade can also happen. So that can be a big boost to our economy.
Yeah, I hope so.
So the whole world was hiking interest rate after the inflation which came post-COVID, other than Bank of Japan. And now finally,
Right.
Bank of Japan has hiked rates. So what's your view on that?
Yeah, I mean, Japanese markets and Japanese economy is obviously in a different trajectory altogether. As you rightly mentioned that after COVID, when inflation started going up, we had seen a very synchronized global monetary tightening, including in India, which was not the case with the Japanese economy. They did not hike rates for majority of the time frame when the global central banks were hiking rates, and now they have started hiking rates because their economy and their market space is facing a different challenge, and that challenge was of lower inflation, of disinflation of last so many decades. So I think now when Bank of Japan has started to actually recognize the higher inflation and started hiking rates, I think that was more or less discounted by the markets because eventually it was about to come. And what happened on 31st of July was that though the market was discounting the rate hike by Bank of Japan, the undertone of that policy was slightly more hawkish than what the markets were expecting. So that led to an unwinding of the yen carry trade, which the markets have been used to for so many years, which eventually led to higher volatility across markets globally.
Puneet, you just spoke about yen carry trade leading to higher volatility. Can you please explain what is this yen carry trade?
Yeah, I mean, a carry trade is borrowing money in a country with lower interest rates and investing that borrowed money in a country with higher interest rates or higher yields. And one of the most popular carry trades over the last decade has been to borrow cheap money in Japan and use it to buy risky assets across the world. Because as we discussed earlier, that the Japanese economy facing its peculiar challenges had negative rates and very low rates. So that was a preferred currency to do the carry trade of borrowing in Japanese yen and investing in other countries across the world which were offering investors a higher yield. Low level of interest rates and enormous amount of quantitative easing meant that the Japanese yen was depreciating versus other currencies, which again was incentivizing the carry trade. And as BOJ has decided to tighten policy right now, it has led to the unwinding of this carry trade, which has caused volatility in global markets.
Sure. So if I understand correctly, you borrow money from a country where interest rates are as good as zero, and then invest it across the world where you end up making more yields because interest rates in other country would be far higher than the country from where you're borrowing.
That's right.
Puneet, US 10-year yields had almost touched, in fact, 5%. It had even breached, I think.
Right.
And if you see now, it is somewhere close to 385 to 395. Where do you think their 10-year benchmark yield is headed?
Yeah, I mean, I will say that the US markets have been pretty volatile. I mean, I'm talking about the bond markets right now. So US bond markets have been pretty volatile over the last, I will say, almost 1 year to 18 months. There have been recalibrations of interest rate expectations in a short span of time over the last 1 year. So currently what we are looking at in terms of the US economy is that the incremental data which has come out of the US economy over the last couple of months is showing some signs of weakness in the US economy, especially if we look at the last week's employment data. And again, that led to another recalibration of the rate cut expectations in the US, where the bond markets currently are pricing in almost 100 basis points of rate cuts by January of 2025. So given the fact that the entire US yield curve is inverted, it's practically more than 100 basis below the policy rate over there. So the US Fed fund rate is 5.25 to 5.5, whereas the entire curve, as you rightly said, is around 4% or slightly below 4%. So that means that the markets are pricing in aggressive rate cuts in a short span of time. And we believe that for the US 10-year yield to move meaningfully lower from the current levels, there should be a sharp slowdown both in the US economy and inflation. Otherwise, we expect that given the current pricing of the rate cuts in the US, the bond yields probably will remain where they are in a tight range of 3.75 to 4% on the 10-year benchmark. The shorter end bond yields probably can go lower once the rate cuts start, and the yield curve there can become positive from the inversion what we are seeing right now. But overall, I'll say that unless we see further recalibration of rate cut expectations, which will be a derivative of signs of a sharp slowdown in the US economy, we think that currently the yields are fairly priced and they will be trading in a range of 3.75 to 4 on the benchmark 10-year in the US.
So what Bank of Japan recently did, do you think because of that, US Fed can go aggressive and cut rates faster than what the street is expecting?
No, Ankit, we do not think that there will be faster rate cuts in the US on back of what the Bank of Japan did last week. In fact, what we think is that the US bond markets are already pricing in aggressive rate cuts by the US Fed in a short span of time, and only a very sharp slowdown in the US economy can lead to faster rate cuts than what is being already priced in by the US economy. So the actions by the BOJ cannot be directly linked to the rate action in the US.
Sure. So you feel US will still look at their own internal data before taking any action aggressively.
Yeah, that's right.
So Puneet, before we summarize today's discussion, your message to Indian bond market investors.
Yeah, Ankit, I think as we discussed earlier, we clearly think that Indian bonds are in a sweet spot. There are a lot of positives working for Indian economy. Indian macroeconomic stability is, very strong right now. So overall, we think that a favorable demand supply scenario for the Indian bonds, steady FPI inflows after the inclusion of JP Morgan Bond Index, probability of India's sovereign rating upgrade over the next 12 to 24 months. Obviously, a high probability of rate cuts also coming in from calendar year 2025 onwards. All these things make Indian bonds quite attractive. We are constructive on Indian bonds, and we would recommend investors to increase the allocation to fixed income, especially given the fact that real yields are positive in India across the curve. And if rate cuts happen, yields go down further, then that can increase the returns to the investors going ahead. And I'll also like to mention that given the current macroeconomic backdrop and the bond market situation right now, we continue to be overweight on the longer end of the curve, and will continue to remain overweight till the start of the rate cutting cycle, because we have seen in earlier cycles that the longer end of the curve tends to do better before the start of a rate cutting cycle. The benchmark 10-year bond yield generally aligns towards the repo rate, and once the rate cutting cycle starts, then the curve becomes a bit steep and the shorter end starts to do better. So we will be overweight on the longer end of the curve and continue to be overweight till the actual rate cut cycle starts.
Sure. So longer end of the curve makes sense for Indian investors, at least till rate cuts begin.
Yeah.
So let me just summarize, for our listeners in 4 pointers. So first being, we expect RBI to cut rates from calendar year 2025, and on the backdrop of good monsoon and, as you just spoke about, easing global monetary policy. Second, we expect 10-year yields in India to drift slow and steadily towards 6.5, maybe by the end of the financial year, which is March 2025. Third, bond markets in US is actually pricing in 100 basis point rate cut, and that can happen by Jan or Feb 2025. Fourth, and the most important, Indian investors should increase allocation to fixed income, and especially on the longer yield, longer tenure, given the real positive yields across the yield curve and expectation of rate cuts coming in. Puneet, I hope I have summarized it pretty well for our listeners.
Yeah, you are absolutely on the mark, Ankit. Thanks for summarizing it. I think you have captured the essence of our discussion pretty well.
Thank you, Puneet. Thank you so much, everyone, for listening to us. I shall catch you on the next podcast.
As always, a very informative conversation. I do have to thank Ankit and Puneet for that rundown and overview, really. I think it's important that we pay attention, of course, when we talk about economics, to the global economic scenarios at play as well. And I think we've done that today, unpacked quite a few trends happening all over the world. Hope you enjoyed this one, everyone. Ahalya here signing off for now, but we will be back with more interesting conversation to help you inform your investment decisions through a macroeconomic perspective. Thank you so much for joining us. Stay safe, stay happy, and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You're listening to the PGIM India Insights podcast series by PGIM India Asset Management.